TSB Banking Group has announced significant restructuring plans. The bank will be letting go of 250 employees. This decision comes as part of a larger strategy to streamline operations. TSB also plans to close 36 branches across the UK. These closures will leave TSB with a network of 175 branches. The bank aims to complete these changes by May 2024. This announcement has sent shockwaves through the banking sector. The job cuts will affect various departments within TSB. Fraud operations, a critical area for any bank, will be impacted. Central operations responsible for back-office functions are also facing reductions. And, as expected, staff at the closing branches will lose their jobs. The news has sparked concern among TSB's workforce. Employees are worried about their futures and the impact of these changes. The announcement has also raised questions about the future of traditional banking. With branch closures becoming increasingly common, customers are adapting to digital alternatives. TSB's decision to cut jobs and close branches is driven by several factors. The bank cites the need to adapt to changing customer behavior. More and more customers are choosing to bank online or through mobile apps. As a result, footfall in traditional bank branches has declined. TSB reveals that in-branch transactions have fallen by 43% over the past 4 years. Cost reduction is another major factor driving TSB's decision. Maintaining a large branch network is expensive. By closing branches, TSB can reduce its operating costs. These savings can then be reinvested in other areas of the business. TSB also aims to simplify its operations. The bank believes that by streamlining its structure, it can become more efficient and responsive to customer needs. This move is part of a larger trend in the banking industry. Many banks are facing similar challenges and are making similar decisions. The rise of digital banking has fundamentally changed how people manage their finances. TSB's decision has drawn criticism from the Unite union. Unite argues that the job cuts are a grave mistake. The union is concerned about the impact on the affected employees and their families. Unite also worries that the branch closures will negatively affect service quality. Customers in rural areas or those who rely on face-to-face banking may find it harder to access services. TSB is not alone in making these difficult decisions. Other mid-sized banks are taking similar steps to adapt to the changing banking landscape. Metro Bank, for example, has cut around 1,000 jobs since facing a potential collapse. The cooperative bank announced around 400 job cuts in March 2024. Virgin Money has also made cuts, with around 150 jobs lost in the first quarter of 2024. These trends highlight the significant challenges facing the banking sector. The shift to digital banking is inevitable, but it comes at a cost. Banks are under pressure to balance the need for efficiency with the needs of their employees and customers. TSB's restructuring comes at a time of uncertainty for the bank. The bank is owned by Banco Sabadell, Spain's fourth largest lender. Sabadell acquired TSB in 2015. In 2024, Sabadell rejected a €12 billion merger proposal from BBVA, another Spanish banking giant. There is speculation that BBVA may still be interested in acquiring TSB. Sabadell's management has set ambitious targets for TSB. They expect the bank to improve its profitability starting in 2025. However, achieving these targets will be challenging in the current economic climate. The Eurozone economy is nearly stagnant, and wage growth is slowing. TSB's future remains uncertain. The bank's success will depend on its ability to navigate the challenges of the changing banking landscape. It must find ways to attract and retain customers in a digital world while also managing costs and ensuring the well-being of its workforce. Only time will tell if TSB's gamble on digital transformation will pay off.